Today, we're diving into some major financial news. The Federal Reserve's recent half-point interest rate cut. This rate cut from 5.5% to 5% is its first major reduction since 2019. Now, coincidentally, this day in history, September 18th, 2007, we also had an initial Fed cut of 0.5%. That's 17 years ago. Same day, same cut. Now, let's break this week's rate cut into three main parts. Number one, what this rate cut means for you as a saver and a borrower. Number two, how it's impacting the housing market and mortgage rates. And three, what it means for the broader economy and your investments. But first, a brief tangent for some definitions and context. The Fed controls two key rates, the federal funds rate and the discount rate. When we are talking about the lowering of rates and these headline-making numbers, we are talking about the federal funds rate, which is the rate that banks lend overnight to each other, and which becomes the baseline for other rate setting. For example, the Fed funds rate indirectly influences mortgages, credit cards, and consumer and business borrowing, lending costs throughout the economy. Okay, by now you're wondering how this affects your personal finances. Let's get into it. For savers, especially those with high-yield savings accounts or holders of Treasury bills, the rates you've enjoyed these past couple of years will be lower. If rates continue to drop, it may entice some individuals with excess cash or savings to seek other assets to own with higher return potential. If you have questions about how much cash you should have set aside, talk with your advisor. For borrowers, the good news is that lower rates generally means cheaper cost to borrow money. So if you have a variable rate mortgage or are planning to take out a new auto or business loan, you might see some improvement. Now let's talk about the housing market. Mortgage rates have started to ease up slightly, and that's good news for anyone looking to buy. The average rate on a 30-year fixed-rate mortgage recently dipped to about 6%, down from last week's 6.2%, and much lower than the 7.8% peak we saw last fall. These changes are material and offer some relief for buyers who've been on the sidelines waiting for affordability to improve. For anyone considering purchasing a property, vacation, or other, it's still important to run the numbers carefully. Remember, a lower rate can help, but it doesn't change the fundamentals. Buy what you can afford and make sure your housing expenses fit comfortably within your broader financial plan. The rate cut has also had an impact on the financial markets. Stock prices increased in the days following the Fed's announcement, with the Dow, S&P 500, and NASDAQ all posting solid gains. Lower interest rates make it cheaper for businesses and households to borrow, which can boost spending and investment, a reason why the stock market tends to cheer rate cuts. Thanks for tuning in today. As always, reach out if you have any questions.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.